I am concerned with the Fed's actions right now. I understand their desire to fight inflation, but I don't think they are looking into the financial markets astutely enough to see the damage they are causing to the plumbing of the financial markets. So they want to raise rates to fight inflation. I get it. But are they looking correctly at the stability of the financial system? And are they pushing too hard on the brakes over here such that the stability of the financial system over here is going to be a train wreck, right? They hit the brakes, the engine hits, and all the cars crash, 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 the train cars. This is what happens when you have a Fed that is managed by a chairman that has never sat in a risk chair.
Former hedge fund manager and Bitcoin financial guru Greg Foss has weighed in on the possible collapse within the traditional banking system, spurred by the ongoing interest rate hike campaigns by the world's central banks. Speculations about a 2008-style banking system collapse started with reports that leading Swiss bank Credit Suisse was on the brink of collapse. Speculation that the bank could have a Lehman-style collapse has had investors rushing to sell its shares. Even a memo from the bank's CEO assuring investors and employees about the bank's future did nothing to quell the rumors. In the memo, the executive stated that the bank had a strong capital base and liquidity position and was looking forward to a long-term sustainable future after the upcoming restructuring. 3 days after the memo's release, Credit Suisse shares declined by over 11% to a record low $3.64. Credit default swaps, an investment type that insures investors against a company defaulting, also rose to all-time highs. Though economists have cautioned that the situation with Credit Suisse is different from what happened with the U.S. investment bank in 2008, it has done nothing to calm the market. Speculations of a widespread banking contagion have increased. In a recent interview, Greg Foss, a former fund hedge manager with over 3 decades of experience in high-yield credit trading and analysis, gives his expert opinion on the situation. Foss details the reasons for speculations about a potential Credit Suisse collapse and what such a collapse will mean for the entire global banking system. Before we take you to Foss's deeply insightful assessment of the situation, please take a little time to hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
But the truth is, there is contagion impact in Canada of an eventual potential fault of a systematically important financial institution. That's what SIFI stands for. Systemically important financial institution, as deemed by the Bank National Settlements. I don't know which one is going to hit the wall or hit your windshield like a bug hitting your windshield. It happens all the time. It is the catalyst that causes credit contagion that reverberates through the financial system and eventually up to the sovereign debt level. I'm not forecasting the eventual demise of Credit Suisse, but I will tell you the market is, because all I need to do is look at a credit default swap obligation on Credit Suisse, okay, lots of acronyms here, a CDS contract on Credit Suisse, and the cost of insurance has risen to levels never before seen, higher levels than during the great financial crisis. And if you just take what that means in layman's terms, it means that the cost to Credit Suisse to raise money, to bring money into the banking system, has the US 5-year rate, let's take 4%, and add on another almost 4% for credit risk for the bank called Credit Suisse. 4% plus 4%, their cost of funds is 8% before they've even made a loan. How many loans do you think are profitable that they can add an incremental loan spread on top of their cost of funds without taking excessive amounts of risk, i.e. lending to zombie companies, and then it becomes circular. So when your cost of funds is 8% and the really good loans out there are at 6%, you're not making those loans. Why? Because you can't borrow at 8% and lend at 6%. You're going to lose 2% on your money. That's what it is. A bank takes money in at a cost of funds and reloans it and takes out the VIG, the spread. Okay? Understand, if their cost of funds is excessive, they have to forego a very important part of the lending market, the low risk part, which means they're lending to higher risk companies, which just causes the circularity. I know you say you weren't involved in this business in school, but just imagine that when you deposit money into a bank, you're really lending your money to a bank, and they turn around and take your loan and relend it at a higher rate and make that spread. And that's how the bank makes money. Pretty cool, isn't it? Until it goes kaboom. Because people say, guess what? The loans you've made are silly, risk adjusted loans. They're going to default, and therefore it's going to cause the whole system to collapse.
Bitcoiners and other cryptocurrency investors understand how fragile the traditional banking system has become, especially under the Fed's seemingly unending generosity. In fact, this fragility and the control by a central authority led to the creation of the world's first crypto asset in the wake of the global financial crisis. If we are going to have another Lehman-style moment, where the collapse of one financial situation topples several others, this is how Greg Foss envisions it will happen.
Well, like you nailed it. It's because all these financial institutions are intertwined, right? They have swap agreements with one another. They have, and when I say swap agreements, interest rate swaps where they swap fixed for floating interest rate obligations. They have foreign exchange obligations with each other. They have interbank lending obligations. Some of these are for very short terms, and some of them are for longer terms that you can't just say, oh, we're gonna take these off the books. It's a contract. You can't take them off the books at your own volition. So given that the banking system is so intertwined, where you have counterparty risk exposure over derivatives, over interbank funding or the cash funding, over all sorts of repo agreements and all of these intricate financial products, when one of the counterparties in the system, imagine a system like a bunch of gears, when one of these gears collapses, all of the other gears stop working because their counterparty risk now reverts back to them. Imagine if you, in the great financial crisis, you were Goldman Sachs. This actually happened. Goldman Sachs laid off a bunch of the risk from Goldman Sachs clients. They laid off a bunch of risks with this company called AIG. Now, AIG was a AAA rated insurance company that got way too far over their skis in selling insurance to the Goldman Sachs of the world, to the point where AIG was absolutely insolvent. And the Fed had to bail out AIG, not because they really liked AIG that much, but really because they liked Goldman Sachs that much that they knew that if they let AIG fail, Goldman Sachs would fail as well because of the counterparty risk exposure back to Goldman Sachs. It's not really that crazy to understand how this works, given that Hank Paulson used to work at Goldman Sachs. Hank Paulson was the treasury guy in the great financial crisis. All right. All of this is the Wall Street internal workings of the machine. And when one of the gears of the machine cracks up, all the other gears stop working. What if the pivot comes and it does not work? Wow. I don't really know what to say about that, except that I would prefer to see the pivot come. And I'm going to define the pivot as this very simply. I don't need them to start lowering interest rates. I just need them to stop accelerating or increasing the rate of Fed funds at a pace that they have never experienced in the world. In the history of a central bank, we have never experienced this degree of acceleration of Fed funds. I would prefer that they just stay and say, okay, we're at 3.25%. We've brought it from 0.25%. We've brought it very quickly to 3.25%. I hope that they stop, take a breath, and evaluate the damage and destruction they've done in the market rather than continue to their target, which is 4.5 to 5%. Well, look, the world is already breaking, in my opinion, at 3.25%. I would prefer them not to do another 75 basis points and then say, well, we'll reevaluate the situation. Guys, you got to see what's happening in the financial plumbing of the system and realize that it's getting blocked up. So my advice would be, if they pivot, how do they define the pivot? I would define the pivot as saying, let's take our foot off the brake. Okay, let's just see what happens at 3.25. And if it doesn't work, meaning we've taken our foot off the brake, we're going to let the drug addict have a little bit more of its heroin, but still the drug addict is like suffering from withdrawal. My preferred path for the stability of civilization is to live with a greater degree of inflation and the drug addict is still functioning, rather than saying, hey, Mr. Drug Addict, we're sending you into rehab and the whole world economy disintegrates. That is the two outcomes that we have. A form of a pivot, A, or absolute global depression, B. I don't care as a Bitcoiner what the result is, because all paths lead to Bitcoin. What I do care about is the stability of the world in both scenarios. And my personal opinion is the world can live with some enhanced inflation. What we can't live with is global depression and anarchy and absolute disintegration of social order.
Do you think we are facing a 2008-style collapse of the traditional banking system, where the interdependent institutions of the system begin to fall one after the other? Will the U.S. Federal Reserve allow that to happen before they step in, or will they hold on to their 2% inflation target? Please let us know what you think in the comments section below. Also, ensure you hit the like button, subscribe to the channel, and check out our other videos on the global economy and the cryptocurrency market. Thanks for your contributions to our growth.